Hello and welcome to another video on my YouTube channel. My name is Joris and today I am here with the update for March of 2025 for the 20 stocks for the YUH-portfolio that I'm following for the YUH-portfolio. And it's finally here, the update that I promised. So you have the 20 stocks. You already know them, but I'm going to go over them anyways. And it's the 20 stocks that I have from the 80 stocks that I have in my own watch list for doing investments. And those 80 come from the 273 companies that I follow. So I follow the 270 companies from the indices from the countries in green. So Spain, France, Belgium, the Netherlands, Germany, Austria, Italy, and Switzerland, of course. And the three other companies, they are also from Switzerland because I like those companies. But yeah, I couldn't include them into the YUH list because I have restrictions on the YUH platform, and I would like to increase the 20 stocks to 28 or replace some stocks of the 20 with the 8 that you see here: Raiffeisen Bank, EVN, Akkermans en Van Haren, Ahold Delhaize, Unilever. So the stock that is noted on the Amsterdam Stock Exchange, not the one on the London Stock Exchange, because then it's in pounds and I want to have just euros and Swiss francs in my YUH-portfolio to decrease the amount of currencies that I have in my portfolios. And then Prosus, Adyen, and Indra Sistemas. And this one is also really important, so it's not financial advice what I'm going to say in the coming hour or so, because it's going to be a long video. But do your own due diligence. I do my best to provide correct information, and I give my own opinion for entertainment reasons only. So be careful and always do your own research. And I do a lot of reading. I control most of the things that I put here on the slides. So, but I can make mistakes again, as well. So just look at it as an entertaining thing. I'm not going to say whether or not you should buy stocks as well. I'm just going to give the numbers. And the prices of the companies are the end prices of the 28th of February, because I started to make the video in the weekend, but I still needed to change 10 slides with the second slides of the companies that I'm going to show for the 10 companies that I didn't get finished in the weekend. So I changed those 10 today, and now I'm recording the video, so it's going to be night work today for me, but I hope you enjoy the video. And if you do that, please like and subscribe to my YouTube channel. So AB InBev, the first stock of the 20, it was 57.64 euros on Friday evening. The dividend that they are going to pay out is 1 euro, and the dividend yield as such is then 1.73%. Their earnings per share was on the Yahoo Finance site 2.75, but in fact we know from last week that it is 3.53 euros. So the payout ratio isn't 36.4%, but in fact 28.3%. So way below the 60% market that I have for most of the stocks. Sometimes it can be a bit higher, but I like to see it below 60%. REITs, that's another thing, of course, so real estate companies, but we will get to that on the Swiss property stock that I'm going to discuss near the end of the video. The PE ratio is 20.96, so with 3.53 it's going to be lower, of course, but yeah, that's for the next YUH update video when I give my quadrants once again. So you always will get the positive points and the negative points of the company. So positive points, it's a global company. It focuses on premium beers. It works with B's and Z delivery as apps, and so business to business business model B's. It has a high debt level, 72.7 billion. It came down. You will see that on the next page, but yeah, they are working on it, and it already declined considerably in the past 5 years. So I like to see that, and it's going faster than the. So they are reducing it faster in the past 5 years than Enel, and that's what I like to see. You of course have, when they operate global, you have currency problems, and the beverage and brewers business is actually a highly competitive business. So when we go over to the numbers, there you see the revenue from 58.3 billion in 2023, it is up to 59.8 billion. So although their volume that they sold declined with 1.4%, they could increase the prices that they asked per hectoliter with 4.3%, which led to the increase in revenue of 2.7% that you see here. They have a free cash flow of 11.3 billion versus 8.8 billion last year. Their earnings per share went up from $3.05 to $3.53. Their debt declined from $74.2 billion to $72.7 billion. And they increased their dividend for this year from 0.82 to €1. They only executed 750 million of their buyback program of 2 billion in as of February of 2025. So they still have 1.25 billion to go to buy back shares. So they have more or less the same problem as me. They want to buy more of AB InBev, but their price got up again. So they missed out on the dip as well. Maybe they didn't. Maybe they still need to declare what they bought in February. But so far as I know, they still need to buy 1.250 billion. They are a good brewer. They produce nice beers. So for me, I think AB InBev is well positioned for future growth. They didn't announce anything on the merger and acquisition front, but they do a lot of efforts in the R&D. And one of those things in Leuven, they have their Global Innovation and Technology Center, where they are improving and developing innovative beverages, revolutionizing packaging, and making brewing more efficient and sustainable. In that regard, they have their sustainability projects, so they are investing in green hydrogen to use in their brewing processes for heating purposes of their brewing vessels. They have the simmer and strip brewing process that they are applying, and they want to have more dry dehusking to reduce carbon emissions and improve energy efficiency. They also have their digital platforms, so the business to business platform B's, and also delivery app Z Delivery in Latin America is very successful. Then we can go over to Accor, the hotels and lodging consumer cyclical company. So the price was 48.06 euros. They have a dividend of 1.18. In fact, it's increased a bit. So they announced a higher dividend already. I should have included it here, but I forgot it for Accor, unfortunately. So sorry for that, but you will see it on the next page that it increases. The dividend yield is 2.46%. So in fact, it's going to be a little bit higher. The earnings per share was 2.33 euros. Their payout ratio is as such around 50%, which is quite nice. and the PE ratio right now is 20.63. They are present in 110 countries. They focus on sustainability and diversification, and they have numerous partnerships with other companies, but the main one is of course with Louis Vuitton. And the negative points, yeah, it's a highly competitive business, the travel sector. So there you have competition with Marriott, Hilton, and all those other groups. But Accor is definitely keeping up, and the luxury section that they have is definitely worth looking at. So when we go to the numbers, you can see that the revenue is up from 5.056 billion euro to 5.6606 billion. So there is an increase of 11% compared to 2023. The free cash flow is up quite considerably as well. So 614 million compared to 396 million last year. Their earnings per share is up from 2.23 to 2.33 euros. Their debt declined from 2.7 billion to 2.5 billion, which is nice because they are also investing in increasing their portfolio of hotels and rooms, and their dividend is going from 1.18 to 1.26, as I said on the previous slide already, that the dividend was going to increase. And they completed the buyback program of 400 million in April of 2024. So they are planning on expanding their hotel portfolio even further. They completed a deal with Covivio, who owns 43 hotels in France, Belgium, and Germany. And Accor acquired 16 hotels in the same regions. They have a global development strategy, so they have a stable pipeline, and they want to open more than 300 properties by the end of this year. And I think they are, yeah, it's very ambitious, but I think they will be able to do it. And they are committed to reduce emissions and eliminating single-use plastic and food waste. Then you have AXA, one of the insurance companies that I follow. So the price was 37.44 euros, dividend 2.15 euros, the dividend yield 5.74%, and the earnings per share was on the Yahoo Finance side 3.27, but the estimate is that it's going to be 3.59 euros. So the payout ratio right now 65.7%, and the PE ratio 11.45. But in fact, it's going to be a little bit lower here and here as well. So I'm really happy that I picked up AXA, and I believe the payout ratio is just 59 or something like that when it's 3.59. So just below what I like to see. The positive points, it's present in over 60 countries. The solvency ratio is still good, 216%, but in fact it came down a little bit, but more on that on the next slide. And yeah, the natural disasters are increasing, so you have more floods, more storms, and that is a possible weight on the results of insurance companies. When you are present in over 60 countries, you have to deal with a lot of regulatory problems, because in all countries the regulations are a little bit different. So AXA needs to be able to deal with that, and insurances are highly competitive business. So let's go over to the numbers. So their revenue went up from 102 billion to 110 billion euros, so up with 8%. Their free cash flow is now more than 7 billion compared to 6.5 billion in 2023. So the earnings per share as an estimate is going to be 3.59 compared to 3.32. Their Solvency II ratio declined from 227 to 216%. I will talk about that in a little second. Their dividend is up 9% compared to 2023, so now it's 2.15 euros that they are going to buy, pay out to their shareholders, and they announced a buyback program of up to 1.2 billion euros. So the outlook of AXA is still good, although the reduction in the Solvency II ratio is something that I don't really like to see. Some people say, yeah, but you can put more capital to work when you only have a ratio of 216 compared to 227%. But you also need those reserves. They are actually, yeah, regulatory obligational. And if you decrease your Solvency II ratio too much, that's something that investors should be wary about. 216% is still okay, so it's no problem. But I would like AXA to increase it back up to 220% or a little bit more. So around 220, 225% is actually way better for me. Mergers and acquisitions. So AXA Investment Managers is going to be sold to BNP Paribas for 5.4 billion, and maybe they are going to distribute a part of those 5.4 billion to their shareholders, but that's more rumors. That's not for sure yet. I believe I've read it somewhere, but I don't think it was an official channel of AXA. So once again, not financial advice. And they have a AXA engineering lab in Lausanne where they are developing innovative solutions and guiding the digital transformation of AXA. And they also have a venture capitalist part, so they are investing in startups and in innovative projects. Then we can go over to BASF, as you can see, in a declining phase because they are restructuring. So their price was 49.21 euros. Dividend went down from 3.40, I believe, to 2.25 euros that they announced to pay out in 2025. Their dividend yield is as such now 4.57%. And yeah, a lot of people thought it was going to remain 7%, but they took the right decision and decreased the dividend in order to be able to reduce the debt and focus on the restructuring. Their earnings per share on the Yahoo Finance website, it's still 0.55 euros, but the estimates are that it's going to be 1.45 euros. So the payout ratio right now, it's 409%, so way too high. When it's 1.45%, it's going to come down, but still more than 100%. And the PE ratio is 89.47, but that one is also going to come down the next quarters as the EPS is going to creep up. And in the coming years, it's going to creep up probably around 4.5 euros or even more. So for me, BASF is a long-term buy, and I'm happy that I have it in my portfolio right now. The positive points, so it's present in over 90 countries. They have a new corporate strategy that they are trying to implement, and so they are also planning buybacks from 2027 on. And I believe that reducing the dividend to 2.25 euros is also the right way to go. So they are still in restructure. That's a negative point for a lot of investors. So I think it's going to remain flat for considerable time before people see the EPS creeping up, and then you will see the price of BASF rise as well. And once again, yeah, highly competitive business, the chemical business. So it is the way it is. So the numbers of BASF, their revenue went down from 68.9 billion to 65.26 billion, so down with 5.3%. Their free cash flow went down from 8.1 billion to 6.946 billion. Their earnings per share is going to creep up from 0.25 to 1.45, and it will increase further the coming years. And the sad thing is that their debt increased from 16.6 billion to 18.8 billion, so they need to work on that as well. but they are doing it by lowering the dividend from 3.50 euros to 2.25, and the share buyback program will start again in 2027. So the investors need to have 2 years of patience, but then they will continue with buybacks. So they are addressing their declining revenue and increasing debt by restructuring, and this will continue for the next 2 years. They sold their food and health performance ingredient business to Dreyfus Company, and they also sold their Brazilian decorative paints business to Sherwin-Williams. And they still are doing R&D efforts, so they have their global R&D network where they have expertise in areas such as chemical synthesis, process development, bioscience, catalysis, analytics, and digitalization. And you also have sustainability projects going on, so they want to produce green hydrogen so that they can collaborate as well with Envision Energy to produce from that green hydrogen combined with the CO2 that they can make methanol. So it's a bit strange to see green hydrogen technology for producing CO2 free hydrogen, but then they are combining the hydrogen with CO2 to produce methanol. But yeah, that's chemistry, of course. And I like seeing that they are collaborating with Envision Energy because that's the right thing to do. Then you have Bayer. Here you see a problem firm as well, so moving down and down and down. From 2018 on, it's because they invested in Monsanto and their debt actually increased from 3.6 billion to 36 billion. So investors weren't happy about that, and yeah, it's still moving down. Here the last 2 months it's more or less moving flat, but it's yeah, a long way from where it was, and compared to the beginning of Yahoo, it's still down 26.67%. So dividends decreased considerably to 0.11 euros because they want to tackle their debt and also focus on restructuring. Their dividend yield is now only 0.48%, but it's the right thing to do. Their earnings per share minus 0.89 euros right now. The payout ratio, because it's a negative earnings per share, I can't give one, and the same for the PE ratio. So positive points for Bayer: global presence. They have a pharma division and a crop science division. But in the crop science division, you have Monsanto, and there you have a lot of problems with court action going on in America. In Australia, of course, there they settled already, so there normally it should stop. But in America, it's in full swing or still. Okay, they won a few cases in the last few months, so that's a good sign, but still it's costing them a lot of money there. And when we go to the numbers, it's not looking too great. So their revenue went down from 58.3 billion to 50.8 billion. This needs to be euro, of course, so sorry for that. Their revenue is as such down with 12.8%, but it's still an estimate. So the results are going to be published on Wednesday. So take a look at this number on Wednesday. Maybe the estimates were right, maybe the estimates were wrong. And the free cash flow, it's gone up a little bit, so from 5 billion to 5.2 billion. The earnings per share is going to be minus 0.75. So on the previous slide, you still saw minus 0.89. So the last quarter will be a little bit better than the previous year, so that it's only minus 0.75. So it's improving, but it's far from okay. So it needs still more work. The debt declined from 33 billion to 32.5 billion. So not a lot of decline effect, but still it's better than BASF where the debt went up. And the dividend went from 2.40 euros to 0.11 euros, which is, I believe, a right decision. The share buyback, so they need to focus on that and restructuring, so no share back for buyer. Future outlook, yeah, they are still restructuring under their CEO Bill Anderson. And if you look at their crop science division, they were thinking about maybe a potential split off of their crop science division, but it's not sure and no final decision has been made because the estimates were that they were going to split it off for 30 up to 45 billion dollar or billion euro, but they bought Monsanto for 63 billion dollar, so they will take a quite big paper loss when they separate their crop science division, but maybe it's the right way to go for Bayer so that the pharma business can grow unhindered from the problems of Monsanto, but that's up to the CEO Bill Anderson and the management team to decide on that. Then you have BKW, so a small player that is getting bigger and bigger and bigger, slowly but surely. The price was 158.60 Swiss francs on the Friday evening, a dividend of 3.40 Swiss francs, dividend yield of 2.14%, earnings per share 9.48 Swiss francs, the payout ratio 35.9%, and the PE ratio of 16.73. So still a buyable share here, and you can see the general direction of BKW. It's going up, but the last 2 years it's actually pretty flat, and you also had a dip. So in the beginning of 2024. So yeah, if you look at it, the last 2 years, it's actually not that appealing. They have positive points, so they have solid financial results. They are doing business in three segments. So they are selling energy, they are providing the infrastructure, and they are also providing the service for the energy selling and the infrastructure part. They focus on renewable energy, so on solar and on wind energy. And the negative points are that they have huge investments ahead, like the solar energy production site in Switzerland, and this means that they will have higher operational costs, and probably because of that, their debt will go up. And they are overall in Europe a small player, but as I said, getting bigger and bigger. So their revenue was up from 4.6 billion to 4.7 billion. Their revenue is as such up with 2.5%. Their free cash flow is also up from 1.1 to 1.2 billion. Their earnings per share is up from 4.20 to 4.50 Swiss francs. Their debt increased from 2.7 billion to 2.8 billion. So as I said, probably it's going to increase further. That's not something that you want to see, but if they do the right investments and their return on capital employed is going up or staying the same, even with increasing debt, then it's the right decision to go on more debt and just have a higher return on their invested money. So their dividend went from 3.40 to 3.62 this year. They don't have a share buyback program. So they are expanding their wind power portfolio in Germany. They bought two wind farms, Holleben and Bippen from WPD, and they also acquired Bockelwitz wind farm in Saxon and three wind farms in Brandenburg. And so they keep doing small acquisitions, but they hardly speak about those acquisitions, so you hardly hear anything. You actually need to go and read in German papers or in in France papers, magazines, to read about the fact that BKW is in fact buying stuff there. So they are also still doing R&D efforts. So renewable energy, besides the above wind farms, they also acquired 6 wind farms in France, and they are going to build four hydroelectric plants in Switzerland. So that is going to increase their debt, of course. And then, yeah, with Bern Airport, so in Belp, they are going to collaborate to put a huge solar farm there, which can provide electricity for 15,000 households. And they are also working on smart grids to distribute the energy more efficiently. Then you have Deutsche Post, DHL. So the price 37.69 euros on Friday evening, a dividend of 1.85 euros, a dividend yield of 4.91%. So earnings per share is 2.69 euros. The payout ratio as such just below 70%. So actually not that great. I would like to see it a little bit lower, but yeah, it's Deutsche Post, of course. The PE ratio here it was 14.01, and above 14 I'm not going to buy it anymore. When I bought it, it was 13.660, so there I was still good below the PE ratio of 14. Then the positive points, it's a global leader, it has strong cash flow, but it's declining. So I want to see a change in the cash flow direction of the previous quarters. And for me, it's a reliable shipper. Of course, it has low margins and it's a highly competitive business. In Germany, the union announced a strike of their workers because yeah they are working pretty long hours, hard hours to work for DHL or for FedEx or for UPS. Those people are really putting in an effort for DHL, and they asked for a substantial wage increase, and they are only getting half of it. So they are still negotiating, and I hope that they find each other somewhere in the middle. When you go to the numbers then, so their revenue is slightly up from 81.16 billion euros to 81.76 euro billion euro, so only up 0.7%. Their free cash flow went actually down from 3 billion to 2.8 billion. Their earnings per share is also going down from 3.29 to 2.92. So on the Yahoo side, it's still 2.69. So actually, the payout ratio and the PE ratio should be better, but we still have to wait and see what the final results are going to be of DHL. Then you have the debt that increased from 17.74 billion euro to 19.43 billion, and they have a stable dividend normally, so still an estimate, but normally it should be equal to last year. And they are continuing their buyback program of 4 billion that started in 2022 and is going to finish in 2025. They are trying to improve on sustainability, digital transformation. They also have innovation center in all the major continent parts of the world, and they serve there as hubs for creative solutions to evolve into solutions that they can use in their actual operations business. And they also publish the logistics trends radar, and this provides an in-depth analysis of logistic trends. And I believe that's something really important, that they follow those logistic trends, and like that they can keep on top of things, and they can keep improving on their weaknesses when they see one occurring. When another firm is really outperforming them in some area that they missed, they try to stay updated on those trends with their publishing of logistic trends radar. and like that, in fact, they try to maintain their advantage. Then you have Enel from Italy. The price is 7.06 euros, a dividend of 0.46 euros, and a dividend yield that is quite high, 6.52%. Earnings per share is 0.52, so you immediately see that the payout ratio is pretty high, 88.5%. But the earnings per share, is that correct? Yes or no? We need to see that, of course. And the PE ratio is 13.58. So they are present in 43 countries. They focus on renewable energy, but they are still pretty serious in the old energy business as well. And they are executing on their strategic plan for 2023-2025. They have a high debt level, 74.9 billion, and they are trying to reorganize with asset sales and strategic financing of their debt. So their revenue went from 81 billion down to 76.8 billion, so 5.2% less of revenue. Their free cash flow went up from 6.1 billion to 6.5 billion. Their earnings per share is 1.25, but it's an estimate, so the results of their fourth quarter still needs to come. So that's why I believe that on the Yahoo website it's still 0.52. But when it's 1.25, then the payout ratio is in fact 36.8, and that is quite nice. But still, the debt, there is a decline of 60.2 billion to 58.2 billion. But in the past 5 years, it's actually pretty flat. And that's why I like AB InBev, although that company has a worse debt ratio compared to their revenue. At least they are reducing their debt faster in the last 5 years. And the dividend is going to go from 0.43 euros up to 0.46 euros. They launched a buyback program of 2.9 million shares in 2024. When it's going to finish, I haven't found anywhere. I haven't read it anywhere as well. But yeah, it's really nice to see that they are buying back shares. They really need to bring their debt down as it keeps weighing on their results. So it should be half of the debt, and then I believe they are way better positioned. But now 58.2 billion is really quite a lot. You see their free cash flow is only 6.5 billion, so it's more or less 10 years that they need to pay off their debt with the free cash flow, so that's quite a lot. And then from the free cash flow, they are also paying their dividends, so it's quite hard to reduce the debt like that. And they are doing their R&D efforts in the usual suspects for energy companies, so renewable energy, decarbonization, innovation and sustainability, and digitalization. Then you have Eni, also an energy company of Italy, a price of 13.85 euros on Friday evening, a dividend of 1.05 Swiss francs, so up from 1. It's a euro, sorry, 1 euro. A dividend yield of 7.58%, so that's enormously a dividend yield of 7.58%. The earnings per share is 0.79, so a payout ratio that is above 100%, and you don't like to see that, of course, and a PE ratio of 17.54. They are present in 69 countries, and they focus on sustainability and energy transition. They have a high debt level, 10.2 billion. In fact, it's not that badly compared to AB InBev and Enel, but still, yeah, it's still a considerable debt that they have, and they are also reorganizing. Their revenue was down from 94.8 billion to 91.2 billion euros, so 3.8% lower. Their free cash flow went up from 3.56 billion euros to 3.8 billion. Their earnings per share is down from 1.40 to 0.79. So because they are restructuring, of course, and they are reducing their debt went down from 10.9 billion to 10.2 billion. So that's a nice sign, but still quite high. But they only need 3 years of free cash flow to reduce their debt to zero, and their dividend went up with 5 euro cents, and they are executing a 2 billion buyback program right now. Merger and acquisitions. So acquisitions, Eni completed the acquisition of Neptune and signed agreements to for investments in Plenitude and Enel. And then they also got rid of some assets. So in Alaska, they sold Hillcorp for $1 billion, and the company also completed a combination of its UK upstream operations with Ithaca Energy. And key points in their annual report, besides the merger and acquisition, was the production increase. So Eni reported a 3% increase in oil and gas production. They also had exploration success, so Eni booked 1.2 billion barrels of oil equivalent of new resources, and their chemical business is being restructured to build competitively advantaged businesses linked to the transition and the circular economy. And then you have Holcim, the building company, the biggest building company of the world. The price was 98.54 Swiss francs, a dividend 3.10 Swiss francs, with a dividend yield of 3.14%. The earnings per share was 5.70 Swiss francs, and their payout ratio was 54.4%, and the PE ratio 17.29. Their positive points: so strong market position in Europe and the USA, and in the USA they are going to split off Amrize, and they keep investing in R&D. The negative points are that the management knows when to do the split. Of course, you see here they are almost at the top that they had more or less around 2008. You have currency problems when you are globally present, of course, and it's highly competitive. So in that regard, it's a hard business to be in, but Holcim is really performing really good. So when you look at the revenue, it was up from 26.04 billion to 26.4 billion, so up 1.4%. The cash flow went up from 3.71 billion to 3.8 billion. Their earnings per share is 5.70 Swiss francs compared to 5.41 Swiss francs in 2023. Their debt declines slightly from 10.7 billion Swiss francs to 10.5 billion Swiss francs, and they are going to increase their dividend from 2.80 Swiss francs to 3.10 Swiss francs. And their share buyback is just finished, so they had a 1 billion Swiss francs buyback in 2024. Mergers and acquisitions, they are going to split off their US business, and that's Amrize, and it will be noted on the New York Stock Exchange and on the SIX Stock Exchange. And this will happen in the second quarter of 2025. And they did a lot of minor acquisitions in 2024, but you always need to find them. So it's not that easy, but they did 27 acquisitions. So they bought Ox Engineered Products in the US, and that's the leader in advanced insulation systems. Then they did an acquisition in Bulgaria, they did an acquisition in Croatia. They also bought a firm in France. They bought 2 firms in Switzerland. They bought 4 companies in Latin America, and they did 4 acquisitions in the fast-growing circular construction market in Europe. But they didn't say what they bought, for how much, and stuff. They just said that they did minor acquisitions there. So if you know more information about that, please let me know in the comments down below. And yeah, R&D efforts, they go for decarbonization and green formulation, so to produce low carbon concrete and cement. Then you have Infineon Technology, a price 35.51 euros, a dividend of 0.35 euros, so just below 1% of a dividend yield. The earnings per share is 1.07 euros and it was 1.62. So in that regard, the earnings per shares are not going in the right direction. The payout ratio is 32.7% and the PE ratio is 33.19. So that's quite high there. Positive points, it's well positioned in the market. So they are working on artificial intelligence, they are working on electric vehicles and electric power solutions. They have strong financial numbers, although this is not that great, of course, but their margins are high, especially in the AI business that they have. And the negative points, the semiconductors for e-vehicles market is uncertain, and it's a highly volatile market where they are operating in, and very specialized as well. So their revenue went down from 16.3 billion to almost 15 billion, so down 8%. The free cash flow went down from 1.7 billion euros to 23 million euros. So that's an enormous decline of their free cash flow, and that's something that you don't want to see. Their earnings per share is 1.87. That are the estimates. On Yahoo, it's 1.07, so you can see that on the previous slide. But so if you recalculate the PE value, then it's actually 19 and not 33. But still, that's an estimate, and sometimes Yahoo is more correct in the long term. So I always take everything with a grain of salt. The debt declined from 5.04 billion to 4.99 billion, and the dividend is going to remain the same. And they completed a buyback of 232.87 million in 2024. So the R&D efforts, I'm not going to read everything because otherwise this video is going to get enormously long. But yeah, their artificial intelligence part is actually the most important one. They are restructuring their sensor units and radio frequencies, so they made a new business unit out of that. But in fact, those two business units weren't performing that great. So the new business unit, they sell it as being something exciting, but in fact they need to come up with great things in order to make this new business unit really tick. So that's also something that you need to be careful of. And as you can see, I always have a remark noted with the comments that they give on their reports. So I'm a bit skeptic on how the business of Infineon is going to evolve. I think I should maybe change Infineon technologies with also from the Swiss stock market. But there it's more or less the same thing. They have 5 businesses, and the only one that is working there is also the artificial intelligence business. So yeah, not that easy. Or maybe I should change it to Temenos. That's maybe the right thing to do, but I don't know. That's maybe something for in the future to look at. Then you have ENG, one of the best banks of Europe. 17.14 euros was the price on Friday evening. Dividend of 1.23 euros and a dividend yield of 7.18%. The earnings per share 1.98, and I say 7.18% not because it's a dividend yield trap. I don't believe it's a dividend yield trap. It's a good bank, and historically it should trade around 15, 17 euros. So I believe the price is more or less okay. okay, the payout ratio is a bit too high right now, and the PE ratio it's still okay, 8.66. For me, the PE ratio needs to be 8 or lower for ENG, but buying a firm at 8.66 PE ratio is always a good thing to do, because those are the values that you pay for a private owned company and not a public owned company. Just like Huawei, which has a P ratio of 4.20 right now. Yeah, that's actually pretty cheap. But yeah, for me, the value is 8. So it has a good mix across retail and wholesale banking, and it has a strong digital focus. And the negative points, it is a bank, and that's why I keep the P ratio at 8, because I don't want to buy too much shares of ENG. Just because it has a PE ratio lower than 18 doesn't mean that I want to own a lot of bank shares in my portfolio. So that's why I put my PE ratio pretty low. And it is interest rate sensitive, of course, because it's a bank, and it has the rules for solvability that it needs to follow, and that is always negative for the bank itself, but it's in fact positive for the economy. Look at what happened in 2008. Then the numbers. So the revenue went up only slightly, so almost no increase, just around 43 million, 430 million increase, 425 million increase in their revenue. Their free cash flow went up from 6.1 billion to 6.5 billion euros. Their earnings per share went down from 2.05 to 1.98 euros. Also, their debt declined a little bit, and that's a good thing. And then, of course, 60.2 billion to 58.2 billion. And they increased their dividend from 1.11 to 1.23, because they also issued an extra dividend of 0.161 in January. Okay, they lowered their overall dividend from 1.11 to 1.06 or something like that. But because of the extra dividend that they distributed in January, the overall dividend is still going to be 1.23. They had a program of 2.5 billion share back in 2024, and their R&D efforts, they are mainly focused on cybersecurity. Then you have Logitech. The price 88.40 Swiss francs on Friday evening, a dividend of 1.16 Swiss francs, and a dividend yield of 1.31%. Their earnings per share is 30.80 Swiss francs, and their payout ratio is 30.5%. Logitech is also a bit strange, because the fiscal year is going to end of 2025 in March of 2025. So in April, halfway April, we are going to get the results of their fiscal year 2025. So these numbers are certainly an estimate, and the PE ratio is 23.26 right now. So they focus on innovation, and they have a wide range of products, but they need to invest a lot of money in R&D in order to maintain their focus on innovation and maintain a good range of products for the people that want to buy them. And because they operate globally, they also have the currency problems that come with that, and it's a highly competitive business. And as a Swiss firm, they have to compete against Chinese and Indian firms, so that's quite hard. But they have great products, and they are selling a lot of products to the people that really appreciate their products. So their revenue went down from 4.54 billion to 4.30 billion, so 5% down. But their free cash flow went up with 114%, so from $0.53 billion to $1.1 billion. Their earnings per share went up from 2.23 to 3.87, so that's up 74%. Their debt, actually, they only have $69 million in debt, so that's actually almost nothing compared to their free cash flow. So they have a really strong balance sheet, and their dividend is going up from 1.06 to 1.16 Swiss francs. They had a buyback program of 1 billion Swiss francs in 2024. Whether or not they executed on it, we will see that in their year report in April. Their R&D efforts, so they are putting more money towards their R&D, which is a good decision because in their sector you need to innovate and keep developing your products, because otherwise you won't sell your products anymore. Then you also have the digital transformation, so they are developing digital platforms and tools to optimize product development, manufacturing, and supply chain management. And they are also looking at the sustainability. Then you have Nestlé, so a price of 87.12 Swiss francs, a dividend of 3.05 Swiss francs, and a dividend yield of 3.50%. Their earnings per share is 4.19 Swiss francs, and their payout ratio is 72.8%. So a little bit higher, but it's a consumer, consumer industry company. So there, the payout ratio can be a little bit higher than my normal payout ratio cutoff value of 60%, and their PE ratio is 20.79 right now. I bought it below 18, so I'm really happy about that. I bought it just around here somewhere, so it declined a little bit further, but then it came up again. Positive points: it's a global leader, it has strong brands, really good brands, and it invests in sustainability, and it has now 30 years of dividend growth. I should have changed that because they increased their dividend from 3 to 3.05 Swiss francs. Negative points: negative image is hard to lose, but with their latest results, I think the sentiment changed a bit. And when we look at the numbers, so the revenue declined with 1.8%. The free cash flow went up with 0.3 billion compared to last year. Their earnings per share declined a little bit compared to 2023, so now it's 4.19 Swiss francs per share. And the debt stayed more or less the same, around 66 billion Swiss francs. And their dividend went up with 5 Swiss francs. Swiss franc cents, so to 3.05 Swiss franc. The share buyback, so they had a 20 billion Swiss franc buyback plan that finished at the end of 2024. The mergers and acquisitions or sales, I need to look at that number, in fact. Wait a little bit. So 20 billion buyback plan of Nestlé. I wrote it down somewhere. Is that correct? Yeah, okay, that's correct. I thought maybe I mistyped and put an extra zero, but it's truly a 20 billion buyback plan that they finished at the end of 2024. I should read up on how many years it ran, because 20 billion is quite a lot of money. But they withdrew the plan to split off their water business, which was really strange, I believe, because they announced it on their investor days in November, but then they did not execute on that plan in January itself. So in November they said, in the beginning of January of 2025, we are going to split off our water business, and then at the end of January they came out and they said, no, we aren't going to do it, because maybe that's a mistake. And I believe that's actually pretty much a mistake. It was interesting that they were going to split it off, because then I would own a company more, and an interesting company, even though they have problems in France with Perrier and stuff. Still, I believe their water business, although it has lower margins right now, is going to be a good business later on, because water is going to get more and more important in the world. And Nestle has the largest R&D organization in, that's because I typed it, and then you have the autocorrect here in Switzerland that changes it to German, of course, but it's industry. Here it's a typo. Here it's the autocorrect that did its work. 4,000 people employed in 23 sites worldwide, where they do fundamental research, which I believe is really important. Here again, a typing mistake. It was the final firm of the 10 that I needed to change today, and you see the rush that I did in order to get it finished, because yeah, it's already 11 o'clock and I still need to do a lot of companies, so it's getting harder and harder. But then you have Nestlé's Product and Technology Center, and there they focus on developing innovative products and technologies for various categories such as coffee, confectionery, food, nutrition, pet care, ice cream, solutions for out of home, and health science and waters. And the pet care business, and actually the pet nutrition business of Nestlé, is getting bigger and bigger as well each year. So they shouldn't neglect that for sure, and investors shouldn't neglect that for sure as well. Then you have PSP Swiss Property. So the retail firm that I have in my 20 stocks, the price was 132.90 Swiss francs on the end of the 28th of February on Friday. A dividend of 3.90 Swiss francs and a dividend yield of 2.93% as such. The earnings per share is going to be 8.17 Swiss francs, so the payout ratio is below 50%, which is quite nice, and the PE ratio is now 16.27. So actually it's now buyable, but you see here the run up, and okay, it went from 137 down to 132 again, but for me it needs to come down a little bit more around this level, so 126, 125 for me to in order to be able to buy it, certainly below 130. Great management team, so I like what Swiss Property is doing. They focus on prime locations, and that's what you need to do in order to build a strong portfolio, and they have consistent dividends. The negative point is it's Swiss Property, so they have a low geographical spread, so only Switzerland, and it's a highly competitive business. When you look at the numbers, the revenue, it's flat for 2024 compared to 2023. Their free cash flow was 305 million compared to 297.7 million. Their earnings per share was 8.17 Swiss francs in 2024, which is quite higher number than the 4.53. But as I said in another video, the valuation of their portfolio makes out a great deal in how you look at the results of PSP Swiss Property. So you always need to look out here how you evaluate Swiss Property. And for me, I didn't put the number here, but their vacancy number is actually more important. So their debt declined from 3.6 billion to 3.2 billion, and their free cash flow is only 305 million. So here, that's why I put those billions in fat to stress the fact that their free cash flow is actually pretty low compared to their debt level. And their dividend so increased from 3.85 to 3.90. They don't have a share buyback program, and yeah, their future is looking promising. They have a good management team. They have a consistent revenue and profit growth. They improve on cash flow, and they do great strategic investments in sustainability and portfolio optimization. They sold 7 investment properties, and they acquired a nice commercial property in Geneva the past year. Then you have Shell with the price of 32.73 euros and a dividend of 1.37 euros. You have a dividend yield of 4.26%. The earnings per share is 2.43 euros and the payout ratio is 56.4%, so just below 60% again. and the PE ratio is 13.23. And for me, the cutoff value is 13.5, so Shell is still a contender for getting into my portfolio at the end of March it will be. But hopefully this trend isn't going to continue before I can buy it, because otherwise, yeah, I'm too late once again. But as I said in the previous video of the YUH updates, it is as it is. So it's a global company, it has strong cash flow, it has a diversified portfolio, so upstream and downstream, and renewable energy as well. But negative points, it needs to invest in R&D for the renewable energy and the zero emissions, and it's a highly unpredictable business. The price gets influenced by, yeah, even Trump. When he tweets something, the price can fluctuate quite a lot of the oil, even the Bitcoin price. This weekend it was incredible. Trump tweets something and it shoots up like crazy. But here are the numbers. So the revenue went down from 402.3 billion to 381.3 billion dollars. So a decline of 5.2%. The free cash flow went up from 38.8 billion to 39.5 billion. So that's then a nice evolution. The earnings per share is $2.43, but on the 13th of March, normally we will get the update of the numbers of Shell, so the fourth quarter results will be published then. And in 2023 it was $2.88. The debt declined from 74.2 billion to 72.7 billion, and you have a dividend of 1.32 that went to 1.37 this year. They have a $3.5 billion buyback plan announced for 2025. And yeah, I'm not going to read everything because yeah, I'm already talking for an hour and 7 minutes now, and my voice is getting a little bit tired. So let's go over to Siemens. There, the price is 221.20 euros. Today it went up even further with more than 4 euros, I believe. The dividend is 5.20 euros, so a dividend yield of 2.35% and an earnings per share of 9.31. But I believe it's going to be 9.80, or it should be 9.80 because they already published their results. So the payout ratio is 55.9% and the PE ratio is 23.76. The positive points that they have is they have a huge moat. They focus on innovation and they have a progressive dividend policy, so they pay out cash and they do buybacks as well. And negative points, they still are pretty big, so sometimes they are slow to react for customers, and it's also a highly competitive business. But they really have a huge moat and they are really good in what they do. So their numbers, the revenue went up from 74.9 billion to 75.9 billion euros, so 3% up. Their free cash flow went down a bit from 10 billion to 9.5 billion euros. Their earnings per share moved also down from 10.04 euro to 9.80 euros, and their debt increased from 49.3 billion euros to 53.5 billion euros. And that's something that really surprised me, in fact. But okay, they I think they already booked in the price of Altair that they are going to buy, and the dividend went from 470 euros to 5.20 euros. They announced a share buyback plan for 8 billion euros for 2024 till 2029. So I believe it's going to be 2 billion every year. And then the future outlook, they are increasing their efforts to strengthen their portfolio of products to drive growth. And they have an acquisition of Altair that is going to be closed at the second half of 2025. And they are going to pay $10.6 billion for it. But it's a great company, Altair, to include in their business. So this acquisition improves their AI powered design and simulation portfolio. And yeah, in the company where I work, the simulations that they run are really important in order to check whether or not all what they programmed for the automation processes are really correct. So improving on their simulation portfolio is a great thing. So I believe that this acquisition is really a good choice of Siemens, and they prove on doing that all the time, picking out the right companies to improve on their business. And yeah, Siemens is just a great company. Then you have the Swatch Group. So 175 Swiss francs, a dividend of 4.50 Swiss francs, so down from 6.50 Swiss francs. So now a dividend yield of 2.57% and the earnings per share 9.99 Swiss francs. Payout ratio of 45% and a PE ratio of 17.19. Positive points: global presence, strong brands, nice spread from entry level to luxury level. And you also have Nick Hayek and the Hayek family that are deciding what to do for the best thing for a Swatch Group. And normally investors should like that, but it's also a negative point because Nick Hayek is not that loved by many investors in the Swatch Group. I'm not one of them. I like what the Hayek family is doing, and also Nick Hayek in particular. So I'm more positive on him, and I also like the fact that they are maintaining their production capacity in Switzerland. Compared to Toblerone, for example, they are moving more and more away from Switzerland, but Swatch really sticks to Switzerland. That's also something that Swiss people should appreciate more, I believe. But that's just, once again, one of my opinions. So the revenue, it went down from 7.7 billion to 6.7 billion, so 1 billion less, so down with 12.2%. That's not nice to see, of course. And their free cash flow reduced from 650 million to 333 million. They slashed their dividend from 6.5 Swiss francs to 4.5 million. But if you see the free cash flow reducing by so much, it's a good thing to decide to also reduce the dividend. So there I believe the Hayek family is really taking the right decision as well. They don't do share buybacks, but the Hayek family is buying more and more shares of the Swatch Group. And then you have the future outlook. So Swatch says that 2025 promises a positive momentum worldwide, but demand in China will continue to be restrained. Swatch expects substantial improvements in sales, operating results, and cash flow. That's what they said on their annual report. Then you have Swiss Re, the other insurance company that I follow for the YUH-portfolio, with a price of 144.30 Swiss francs. Yeah, you can see it. The price really moved up. So it was flat for more or less 8 years, and then in the past year and a half, it's going up and up and up. And the dividend is 6.19 Swiss francs right now, so a dividend yield of 4.27%. When you bought it here, you will have a dividend yield of more than 8%. But now the earnings per share is 10.36 Swiss francs, so a payout ratio just below 60% and a PE ratio of 13.93. The solvency ratio is 275%, so way better than AXA, or way worse if you want to have more capital at work and work for the company instead of being on the reserve, of course. But yeah, the solvency ratio, it's a reinsurance company, so there I also like to see a higher solvency to ratio compared to a normal insurance company. It's very sensitive to natural disasters because it's also present in the United States of America. And once again, yeah, insurances, it's a highly competitive business. So the numbers of Swiss Re, the insurance revenue went up from 43.9 billion to 45.6 billion, 3.9% up as such. The net income went from 3.1 billion up to 3.2 billion, and the return on equity of 15%. So that's a really nice number, but that 15% is way lower than the 16.2% that they had in 2023. So hopefully in 2025 the ROE is going to go up again to more towards 16%. But 15% is not bad at all as well. But yeah, when you have seen 16.2% in the past, you want to have that again, of course. The earnings per share is now 11.02% dollar compared to 10.5 dollars in 2023, and their Solvency II ratio is up 1% compared to 2023, so way better than for AXA. But as I said, it's a reinvestment company, so a reinsurance company, so there it's not really comparable to AXA as such. And the dividend is $6.80, so 6.19 Swiss francs, moving up to $7.35, and that's going to be more or less 6.61 Swiss francs with the currency that is a currency factor that is momentarily applicable, and that means that it is plus 8% in dollar value, so 6.80 to 7.35, but in Swiss francs it is up 6.8% compared to the Swiss franc itself. And that's just because the Swiss franc is yeah, it's a strong currency, and you immediately see it. They announced the increase in dividend, and from the moment that they announced it, the dollar moved down compared to the Swiss francs, and there you already have 1.2% difference in increase of the dividend. And they don't have a share buyback program. Then you have the final company, Volkswagen, with a price of 107.10 euros right now and a dividend of 9 euros. And they are going to normally maintain the dividend at 9 euros, but nothing is final there. They are still discussing in Germany about that. Dividend yield of 8.40% now. The earnings per share were 24.43 euros. So the payout ratio is 36.8%, so still lower than 40%, which is nice. And the PE ratio is 4.38, so actually pretty cheap valuated company. Global presence, they have now a strong focus on e-vehicles. They have a diversified range. The negative points, they have a high production cost. They worked on that in Germany, they worked on that in Belgium. I already talked about that a lot in the past. Audi as well, they also reduced their cost in Belgium, unfortunately for Vilvoorde, but yeah. And then the range of their e-vehicles is actually not that great, so their batteries aren't that good, but they are working on that. And I like good family cars in the diversified range of the cars that they have. As I said, I already complained about that in the past as well. I bought a Ford Tourneo with my wife because we have 3 kids, and if you want 3 good seats at the back, an SUV won't cut it, because there it's 2 good seats and then a smaller one in the middle. And when you have 3 kids, there is only always one kid that pays the price and needs to sit in the middle. And yeah, then you need to go for a Caddy or a Fortuneo with a Volkswagen engine. And we went for the Volkswagen engine Fortuneo because it was 3,000 Swiss francs less to pay for exactly the same car, in fact. So, but it's a highly competitive business, and here you can see the numbers. So the revenue declined a little bit, 0.7% down. Their free cash flow was comparable compared to last year. The earnings per share went down considerably because they wrote off a lot of their restructuring costs already in 2024. Their debt increased from 178.4 billion to it needs to be euro here again, sorry for that, 209.9 billion. So that's not great at all, and their dividend is going to stay the same. It was 9 on my previous slide, so I believe maybe it's a typo here. It should be 9 and 9, or maybe it was 9.06 and it remains 9.06. So on one of the slides I made a mistake, so sorry for that as well. But yeah, as I said, I worked on this presentation for more than 2 days, and even today. And this one was the after this one I did Nestlé, and that was the last slide. So I'm really getting tired. It's already 1 hour and 20 minutes that I'm recording this video. So sorry for making it this long. But they don't have a share buyback program, and then I tried to do my best to list all the cooperation agreements that they made and arrange them more or less in the ranges that they are related to each other. So Microsoft, Argo AI, they are more in the cloud business. Then you have Rivian that is working on the software and electronics for next generation e-vehicles. You also have Xpeng of China with e-vehicles for Chinese market and automated driving. Ford that is also going to work together on autonomous driving, and you need those cloud-based corporations to be able to develop the autonomous driving because you need the data behind it. Then you have FAW Group, so and SAIC Motor Corporation to sell Huawei and Skoda or Audi vehicles in China. Then you have GAC Motors, so also e-vehicles for the Chinese market. Then you have QuantumScape, specialized in solid-state battery production. Goldsion high-tech battery production for e-vehicles in China. Northvolt's Swedish battery manufacturer that Huawei asked to build a factory in Germany for battery production so that they have a good supply insurance for their batteries, for their e-vehicles that they need to improve the range of as well. They also are going to work together with Umicore for precursor and cathode material for cleaner batteries. And Umicore, I used to invest in Umicore when I was still living in Belgium. So I like to see the name of Umicore here. And then you have Vulcan, which is going to produce low carbon steel for the Huawei group. And with that, that was the last company. The video is quite long, so I'm not going to extend it any further. But if you like this kind of content, please subscribe to my YouTube channel. And with that being said, thank you for watching to this one, and see you on the next one. Bye.